Hello, this is Jason Green. This video looks at how to apply the discounted cash flow model to a real firm. In this video, we'll look at how we use different sources of data to inform the forecast that we make in the discounted cash flow model. My previous video covers the background and some issues surrounding the discounted cash flow model and shows how to build the basic model upon which we will build here. Now that we've seen how to build a valuation model in Excel, let's talk about a few things before we apply this to a real firm. First of all, I want to point out this isn't the only way you can build a valuation model. This is simply my style of doing it and how I've approached this particular one. We can do a lot of different things here. I've set it up so that I can see the cash flows in this yellow area. And I've set it up so that each year's cash flow is based on a growth rate from the previous year. That's not how it has to be. In fact, what many analysts will do is they'll actually build a cash flow forecast for each year individually, and they won't apply some growth rate to a previous year's total cash flow. Instead, they'll build this from the ground up based on the definition of what free cash flow is. It all starts with revenues, subtracting out costs, you get to the net income, you build up to the operating cash flows of the firm, then you subtract out those capital expenditures. If you forecast each of those items year to year, you can arrive at a free cash flow forecast for each year, and then you would put it into basically what this technology is to discount those cash flows based on these other assumptions to arrive at an intrinsic value per share. So this framework, again, is very flexible, but I don't want to pretend here that this is the only way to build a valuation model. All models will look similar to this in terms of the final stage, but how you build up each year's forecast, of course, is going to differ from analyst to analyst. With that said, let's use this approach right now to come up with a valuation for a real firm, in this case Microsoft. Now we have to start filling in all the information in terms of the inputs and assumptions. We can find these inputs for real firms from various sources, some of which are freely available and some of which you can pay for. I've listed first the freely available sources, and I've started with the US SEC filings of the companies that are available through EDGAR. The reason I've listed this first is that ultimately, this is where all data comes from. The data originate with the firm. The firm makes the data public through filing them with the SEC. All other sources really get the data from that primary source, the US SEC filings. To get the SEC filings for the firm, you go to the EDGAR database. Just do a simple search and you'll find a link to EDGAR for the SEC. When you first pull up the SEC site, you have various ways to search for the company filings. I'm going to use the fast search method by putting in the ticker symbol for Microsoft, MSFT. That brings me to a page that lists all the filings that Microsoft has made. I'm looking for the financial statements or the 10Q or 10K filings. So if I navigate down this page, I can locate the company's most recent annual disclosure of their financial statements in their 10K. Once I've navigated to the company's filing of their 10K, I can navigate further to their financial statements. Within the financial statements, you can of course find the balance sheets or the income statement. What we're interested in specifically is the statement of cash flows. As I navigate to the firm's cash flow statement, from the cash flow statement, we're looking to build the firm's free cash flow. Remember, this is operating cash flow minus capital expenditures. We find the operating cash flow on their net cash flow from operations, which in 2013 was $28.833 billion. Looking on down the cash flow statement, we can find their capital expenditures as additions to property and equipment of $4.257 billion. Subtracting the capital expenditures from the operating cash flows gives me a total free cash flow of $24.576 billion for Microsoft in 2013. This will serve as my initial cash flow from which I build future years' cash flows. As I mentioned before, these other available sources actually rely on the filings that these companies make with the SEC for the data that they provide. They also supplement these data with market-based data. For example, as we navigate to Google Finance and search for Microsoft, we'll get a quote in terms of the recent trading price for Microsoft, as well as other market information, such as the 52-week range, highs and lows, the trading volume, etc. Of course, what's relevant to us is how we can use this in valuing the firm and doing our analysis of the firm. We're going to actually make note of the $36.80 as the current price of Microsoft, because we'll use that as a comparison to the intrinsic value that we solve for. But first, I'm going to navigate to the financial statements within Google. Notice that when we bring up the firm's income statement in Google, we are not just presented with the most recent year's income statement. In fact, we have several years historically. This is very useful for an analyst in building a model because we might use the information from the historical data to inform our forecast of future years' cash flows. For right now, let's navigate to the cash flow statements. On the cash flow statements, it's not surprising we find nothing new in terms of what we found on the SEC filings. Again, these data were sourced from those SEC filings. We see the $28.833 billion in cash flow from operations that we saw in the 10K, and we also see the capital expenditures of $4.257 billion. This shows one of the advantages of using one of these freely available sources other than SEC filings. Specifically, they can provide more information organized in a way that helps us as we build our models. Let's take another look at one of the sources available on the web at morningstar.com. I actually prefer the site because I think it organizes the data in a very useful way. Again, when we go to the first screen for Microsoft, we see the stock's price of $36.80 per share. Again, what we're interested in here is looking at the free cash flow of the firm. We find this again by looking at the Financials tab. When we initially bring up the Financials tab, we see the income statement for the firm. And again, not only do we see the most recent income statement as of June of 2013, but we see income statements going back to June of 2009. Turning to the cash flow statement, we find the information we need to build our free cash flow, specifically that initial cash flow that we'll use for the first year, but also we have that historical data going back several years that will provide context as we make those forecasts of those future cash flows. So again, we see that $28.833 billion in cash flow from operations. We also see the $4.257 billion in investments in property and equipment as our capital expenditures. Going on down the cash flow statement in Morningstar, you can see that they've actually calculated the free cash flow to the firm for us. $24.576 billion for the year ended June 2013. Notice also that we can see $29.321 billion for the year ended June of 2012, and going back we have the previous years as well. I'm actually going to take those values from the previous years and enter those into my spreadsheet model. I should give a disclaimer here before I start that the results of this model are not in any way going to be a recommendation for me to buy or sell Microsoft. I'm simply using Microsoft as an educational example here. With that disclaimer made, let's go forward here and see what we can learn about valuing a company. First thing is a beta. I'm going to enter at 0.95, and I'm going to leave a discussion of that for just a few minutes from now. The market value of equity is simply the company's market cap. If you look this up on various sources such as Google Finance or Yahoo Finance, you find that Microsoft's current market cap is about $305 billion. So we'll enter that in. In terms of our debt assumptions, this is where I actually go in and look in the various sources such as Morningstar for the firm's long-term debt, and I look at the yield to maturity on the company's bonds. The thinking there is that if the firm were to issue new debt today, then the yield to maturity on the firm's long-term bonds is the best indicator of what the market demands as far as a yield on those long-term bonds. It's not going to be perfect, but it's a good starting point. So if I consult, for example, Morningstar on this, and I go to the Bond tab on the Morningstar website, first of all, we see their credit rating is currently AAA. We see their outstanding debt at $22.7 billion, so I'm going to actually go ahead and enter that in as the market value. Although I'll have to say I'm not sure that that's a market value. I'd want to check that with another source as well. Their pre-tax cost of debt, again, that's what we're focused on here. I want to use the yield to maturity on the firm's long-term bonds. So scrolling down in that bonds tab on Morningstar, I see that there are some long-term bonds from Microsoft that are trading at a yield to maturity of about 4.39, 4.61%. So 450, 460 basis points. seems to be a reasonable place to start for the pre-tax cost of debt. In terms of the effective tax rate, we could do a lot of things here. We can use a standard marginal tax rate for a company, but many companies, I would say, don't quite pay that full marginal tax rate. I'm going to enter in 20% here for the marginal tax rate, or the effective tax rate for Microsoft. This gives them an after-tax cost of debt of 3.68%. We can see that this carries down to their weighted average cost of capital of 8.38%, given both our equity assumptions and our debt assumptions. We're at the point where we need to put in our initial cash flow and our long-term or terminal growth rate for the cash flows. And as I've said before, the best estimate for the initial cash flow would probably be the firm's latest cash flow. So sort of by default, I'm just going to go ahead and enter that in, the $24.56 billion in free cash flow that we saw in the firm's financial statements. For that long-term terminal growth rate, I'm going to mirror what I did in the hypothetical example here and use 3%. This is just my standard that I put in for a model when I first approach it, where I'm using 3% to represent the long-term growth in the overall economy. You need to be careful here, though. Something significantly above 3%. When I say significantly, 4% might be too high here, because this is a long-term growth rate that technically, in this model, in the theory behind this model, this long-term growth rate lasts forever, and no firm can grow significantly faster than the economy forever. It's just a logical inconsistency. The max you should really be putting here is that long-term growth rate of the economy. Before turning to an analysis of the historical free cash flow data, which I'm actually going to use in order to help me make my forecast of these near-term cash flows, I want to turn to looking at one of the other vendors. So we went through the free sources of data. One of the vendors that I listed there was Bloomberg. So I'm going to open up Bloomberg Professional and talk about where we would find some of these historical cash flows to give us some context for making our free cash flow projection for Microsoft. Paid vendors not only have more information, but they organize the information that you could find on other sources in a way that makes it easy to access and makes it very quick and efficient to use. So let's see how we would do this with Bloomberg Professional. In the home screen, I'll just type Microsoft and hit the F8 or equity key and then hit go. This brings us to the main menu for Microsoft. Since our model really relies on the financial information or the information from the company's financial statements, we're going to go to FA or Financial Analysis. And this brings up tabs that have the income statement, the balance sheet, and the cash flow statement, among other items here. Of course, for the discounted cash flow model, we're most interested in the cash flow. So we'll click on the cash flow tab. And right away, up top, you see cash flow from operations in fiscal year 2013 of $28.833 billion. Just below that, we can find our capital expenditures from cash flow from investing activities, the $4.25 billion. So that's how we would calculate the free cash flow. Of course, Bloomberg does this for us. If we scroll all the way down to the cash flow statement here, we see free cash flow, which I've highlighted here, $24.56 billion. But more importantly, one of the great uses of a tool like Bloomberg is that you see here all of the years together. We see fiscal year 2013, 2012, 2011, 2010, and 2009 just on this screen. But if we start scrolling, we can go back even further to more years. It's all right here at our fingertips. So right away we have the historical context for the data that goes into our free cash flow model. More than this, we can also find the parameters that we've already put into our spreadsheet. We can find some information about those. For example, if I want to see what the cost of capital is for Microsoft, at least according to Bloomberg, I use the weighted average cost of capital function, WACC, and hit go. This brings up Bloomberg's calculation of Microsoft's cost of capital. Notice the warning at the top of the screen here. It's a rough approximation. As I've been saying, these are inputs. These inputs are really judgments by the analyst in using the model. These are not quantities that are necessarily agreed upon by everyone. So what we're looking at on this screen is simply Bloomberg's estimate of what these quantities are. Under cost of capital, you see that they've broken down the equity and debt and the preferred equity. We're going to focus on the equity and debt. Notice that they have the debt ratio of 6.9%. We had 6.92, so we actually have some agreement here with Bloomberg's calculation. They also show the cost of both equity and debt. For equity, they show a cost of 9.4%, and for debt, 2.1%. Now, those are actually reasonably close to what we had as our estimates or our assumptions about these input variables, but we can click to see further transparency into how Bloomberg has calculated these. First thing to note when we click on the cost of equity is that it shows you what their cost of equity estimate is, the 9.45%, and then they show you the model that they've used to calculate it and the parameters that they've used there. So the risk-free rate that Bloomberg is assuming is 2.74%. The equity risk premium comes from the same model that we were using, the CAPM type model, with a beta of 0.9 times the country risk premium. Notice the risk premium that Bloomberg is using is 7.44%. Together, these give them their total cost of equity. Clicking on the cost of debt tab, we see the effective tax rate that they've assumed of 18.59% and their pre-tax cost of debt. Their pre-tax cost of debt in this case is 2.74%. This all leads them to their after-tax cost of debt of 2.13%. Again, these are Bloomberg's calculations of these variables. It's nice to see here that we are actually quite close to Bloomberg's numbers, but I would caution against just blindly using someone else's numbers. The financial analyst is supposed to come up with their own judgments for what their inputs are for their model. That's what makes the valuation their own. Closing out of the cost of capital, I get asked a lot of times of where you would find the beta for a company. This is actually a pretty straightforward calculation based on historical returns for a company. Bloomberg offers a nice tool for calculating this yourself. They also show what their default estimate of beta is. So if you just use the beta function, type beta and then go, it brings up all of the inputs into their calculation. At the top, we see that the relative index they're using for the calculation is the SPX index, or the S&P 500. They're using a weekly frequency from February of 2012 through February of 2014. So they're using weekly data for 2 years. Notice on the right-hand side, you see the adjusted beta of 0.906. That's the Bloomberg default beta for Microsoft. A raw beta of 0.86 is what is actually calculated from that regression line that's shown in the graph. Personally, I don't like to use weekly data. I also like to use a longer time period, and I like to use a broader index as my relative index. I'm going to change it to the Russell 3000 index, which is a broader index against which to measure this. I'm going to change the frequency to monthly. I'm going to go back to 2009 in my calculation. Now we see the beta estimate of 0.912 for the raw beta and an adjusted beta of 0.94. This is very close to the 0.95 that I entered into the free cash flow model. At this point, we have all of the information we need, at least from a simple model of providing some context into our free cash flow estimate. But really, an analyst is required to make an estimate of future free cash flows. And we probably would like a little more insight into what free cash flows have looked like historically before making our assumptions or our forecasts. One of the things I like about Bloomberg is that we can see a lot of detail into the financial statements with just a few clicks. For example, on the screen for the cash flow, we see the operating cash flow and its components. For example, we see net income for the last few years. The most recent net income of close to $22 billion, the previous year's income of $17 billion, which is down substantially from 2011's income of $23.15 billion. We can see that detail there. In fact, we could look further into that. We might ask the question, what has been happening to Microsoft's net income over the last few years in terms of what's driving it? Why did it go down substantially from 2011 to 2012? To see into those details, we just click on the income statement, and here right away we can see the top line in terms of the revenue for 2013, 2012, and 2011. We can actually see that from 2011 to 2013, that revenue actually grew each year. If we go back a little further, we can see that this growth even dates back to at least 2009. So revenues have continued an upward trajectory. We can then go further down here and see why it is that net income has gone up and down over the last 5 years. And really, this is telling the story of these financial statements, what's behind those numbers. This can aid the analyst in making that free cash flow projection for future years. So if we go back to the cash flow statement, one of the other things that will cause free cash flow to, of course, fluctuate is the level of capital expenditures. We can see back to 2009, capital expenditures were about $3 billion, down to $2 billion in 2010, but have been increasing. Actually, they were about the same for 2011 and 2012, but then increased in 2013 substantially. Looking at the last 12 months column, meaning adding the 6 months beyond the end of the fiscal year in 2013, you see that capital expenditures were actually on pace to be a little higher for that next fiscal year. For that reason, we might project that the free cash flow for Microsoft might be a little lower. Other benefits to a tool such as Bloomberg is that we have a lot of other information, again, that can add context for our cash flow projection. For example, if we click on the Segments tab, we can see revenue broken down into the different business units of Microsoft. This, again, might help us project if we think a certain business unit will have better or worse results going forward. This might help us make that forecast of our free cash flow. Since we're just building a very basic model, I don't want to go much further into the detail. I just wanted to illustrate how much detail could be available and how much you can rely on a lot of information to make that forecast of free cash flow going forward. So let's go back to the model. Now that I have those historical cash flows, I can use those to help me understand, or at least help me to make a reasonable forecast of future cash flows. Now, I want to be careful here because this by no means is the only thing I should use. In fact, they come out of the income statement, they come out of the cash flow statement. They're influenced by the revenues each year, the costs each year, and the investment decisions of the firm each year. Remember where the free cash flow comes from. It's the cash flow from operations minus the capital expenditures. So we see over the last 5 years, we see actually starting from 2009 through 2012, we see pretty significant growth in those free cash flows. We would want to dig in and see where that was coming from. Is that coming from top line revenue growth? Or is that coming from cutting costs? Or is it coming from the fact that perhaps this firm didn't have significant capital expenditures recently that they had in the earlier years? These are things that you would want to know in order to use them to inform your forecast for the next few years. Now, I've looked at some of those things, and ideally you would want to put them into your model here, perhaps have another tab in Excel, or maybe even put them on the same sheet. Right now, I'm just trying to build a basic model, so I've really skipped over that, not because I don't think it's important, but because we're building a basic model here. And so this is at sort of the bare bones, or the very least of what we need to give context to our calculations. I happen to have seen that over the past few years, Microsoft has actually been ramping up its capital expenditures a bit. In fact, the 2013 numbers end as of June. At the time that I'm building this model in this video, actually we're into 2014, and I already know that we're on track for Microsoft to have larger capital expenditures this year than they did in previous years. So my initial growth rate for that first year might in fact be negative. And just to reflect, in fact, it would continue this trend of a negative free cash flow growth from 2012 to 2013 into 2014. So I might actually start out by putting a negative 10%, let's just say, in that first year. Now in my model, I'm already calculating a firm value here. You can see my intrinsic value still shows an error because I haven't put the shares outstanding. If I fix that and I put in the shares outstanding, which Microsoft has about 8.3 billion shares outstanding, then it calculates my intrinsic value per share. That intrinsic value per share, just to remind you from the hypothetical model, is the firm value minus the debt value, giving us the residual equity value, and then dividing by the shares outstanding to give us the $40.96 per share stock price. Now that's a per share stock price assuming zero growth from years 1 through 5. I've already put in the negative 10% growth for the current year. So if I change this, let's say that I think that their free cash flow will continue to decline over the next couple of years, then this obviously lowers my intrinsic value per share. If I put in positive growth for the next several years after that, then this raises that intrinsic value per share. And therein lies really the convenience of having a valuation model like this in Excel. You can change your assumptions, you can put in your forecast for those near-term cash flows and see the impact that they have on that intrinsic value per share. I always find it convenient to also put the market price into my model here, not really into the model, but at least putting it on the same sheet so that I have something to compare it to. You'll recall from, I think it was Yahoo Finance or from Morningstar, that the most current price quote for Microsoft was $36.80 per share. You can see that the intrinsic value per share that I've calculated here, even though I didn't put a lot of thought behind these growth rates that I've put in, I've come up with an intrinsic value per share that's actually quite close to the market price. This is another benefit of having a valuation model. We could, in fact, keep changing these numbers until we got the market price. If I lower my growth rate, in fact, in year 3, I can lower it to about, it looks like about 1.5%, maybe a little higher than that, as I approach, in fact, 2% in year 3 gets us right on the money. Of course, who knows if this is the pattern of growth that we would see in Microsoft's free cash flows. The point is that we've been able to put in these parameters into this model, use the science of the valuation model, which does the time value of money calculations for us, and we can see what our judgments have led to in terms of the intrinsic value per share, or we can see what judgments the market must assess for this company in order to come up with a market price. In this case, the growth rates that you see on the screen are consistent with the market's valuation of Microsoft, assuming everything else on the screen is accurate. I'll just emphasize again here, none of the parameters that are in red are actually known. These are all estimates or forecasts or judgment calls. This is what is up to the analyst to put into the model. A couple of other things I'll mention here. As I've already said, that this model is actually fairly simple. I consider this to be a bare bones model, but it's got all of the essentials in it. In the end, every analyst who uses a discounted cash flow valuation model has to have the features that we have here, where you have a free cash flow that's discounted, where growth is projected, and you calculate, after subtracting out the debt value, you calculate an intrinsic value per share. We can't get away from that end process. What's behind these numbers, what goes into manufacturing these numbers and producing these, might be judgments about all of the components that go into the calculation of free cash flow. In the end, each model is only as good as the judgments of the inputs and assumptions that go into it. The science in terms of the time value of money is pretty set. The art of security selection and evaluation really comes in the judgments about these inputs. I hope that this video has been helpful. Feel free to leave me a comment in the comments section. If you'd like to see videos on other topics, I'd appreciate hearing about that as well. Thanks for watching.